You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, Jim, good to be with you.
Some incredible numbers coming out of the Chinese stock market.
Well, their overall stock index, the SSEC, has been making terrific gains since early in the year. Really outstanding gains. Like approaching straight up. Now, that's one thing in an index to do that, but within their financial markets in Shanghai, they've been doing new issues of stocks. They begin to call them initial public offerings. Anyway, so they had one here I read about just here a week ago, where they had the company wanted to raise $1.2 billion sell that amount of stock, and the number of orders for that particular new issue of a new company amounted to, they said the write-up was equivalent to the annual economic output of Hong Kong. So I looked it up, and the GDP for 2014 for Hong Kong was $274 billion. So the orders for this new issue were 200 times the amount of stock being offered. So a long time ago, I was with a good regional brokerage firm. Actually, it was 1968. Hot new issue market, and on the institutional desk, so you could see the way the orders were coming in, and but you could only allocate tiny little amounts to each account. You just more or less did them a little favor, and nobody could get a decent position on. So then you open up a whole bunch of, an individual would open up an account at a trust company, at another broker, and all around town, putting in huge orders. So this went on, and there was a couple of accounts then here in Vancouver that we figured out who they were, and then came, well, some of these issues, and back up a bit, were, coming out and doubling, tripling within a week or so. It was phenomenal. So anyways, then came the one that you realized was the turkey. So this guy got filled all over town. So the week before, he'd been complaining about not getting any allotments and allocations, and then bang, he was filled, and it was a terrible scene. So this is what you have now. No, at this moment, it's impossible to tell how long this hot new issue market will run. But at the same time, you know that it'll inevitably be a disaster. But anyways, in looking at the SSEC, their index for Shanghai, in going straight up, we looked at it, the pattern that we ran in 2007. And our proprietary trading model on hot action gives what we call upside exhaustion readings. And then when you get a really big move like what's going on now in Shanghai, there were 3 sets of those upside exhaustions to the top in 2007. This one has had 2 sets, and last week wrote that we were looking for yet another rise strong enough in Hong Kong to register upside exhaustions. And then there was also the story about inflation has got right into individual accounts in villages in rural China where they're putting their money in, opening up accounts and putting their money in because they know that the Shanghai A index is going to be listed on Morgan Stanley's China index, and that then will, of course, add to the stock. So here you have villagers in rural China getting into the stock market because they think that Morgan Stanley's going to lay a big blessing on the market. So, I mean, can you find anything more naive than that? I don't think so. So it's a trap in waiting. It's an accident being built, whichever way you want to look at it. Now, what we want to do is look and see in other markets, in the key markets, about what's going on. And early in the year, in January, looked at the way the U.S. bond market on treasuries was running, and said this, and then also in an eye to what was going on with the bond yields in Europe, particularly German ones, and described it as ending action, where, hey, as this one peaks, it could be the end of the long bull market for bonds. And then at the end of January, our technical research came with what we call the upside exhaustion, and it was such a strong signal. We've only seen it about once in 7 times since the bull market began in 1981. And then you got the good correction setback going on in U.S. Treasury bond prices. And then by it was April the 9th, we noted the incredible action in the German yield, which was then down below whatever, and said that this change in the long treasury market would probably hit the European market. And that was April 9th, and the best on the European bond market was April 19th or thereabouts, plus or minus a day. So then that's when the German 10-year note got down to 0.59%, and then it's recently hit 1%, which is a huge, huge increase. So I want to relate this to the central banks, where we don't know how much or what maturities, but they definitely have been positioning in European bonds, the European Central Bank. So if you get a bond yield increase like that, you're getting a proportionate decline in the price of the bond. And these bonds are held in the central bank reserves. So their reserves are being marked down quite noticeably. And then that then reduces their ability to inflate. Now, the other thing going on in credit markets is that the difference between high-grade and low-grade bonds, which we call the spread, it seasonally can narrow into somewhere around May, and we've had that because you had the disaster in junk bonds and credit spreads widened as crude oil prices crashed down until January, and then you've had the narrowing since, and then the last, I'd say 6-8 weeks of the narrowing has been on this seasonal move and it's pretty good. The yield the spread came into 176 basis points, and it's been here for a few weeks. Then last week it started to move, and we had to get it above 180 basis points, and then as of yesterday's post, it's out to 185. So that is turning the trend on this thing, and we should also look back to 1998, when then long-term capital management was highly leveraged on narrowing credit spreads, and then the seasonality went against them in that June, and then by the time July came, the spreads were widening, and then that just absolutely wiped them out. It's $400 billion. That was the biggest hedge fund collapse then. Sorry, pardon me, it was $4.5 billion. So at any rate, here we are. You have very, very frothy speculation going on in Shanghai. You've had outstanding action in I guess biotech's IBB have been very good in North America, and you now are getting the spreads widening. So this is a big caution or alert, whatever you want to call it. The other one that was interesting was that we were looking for most of the commodities to rally out of December, January, out till around May. And the base metals did good, as did the base metal mining stocks. Crude oil had a nice vigorous bounce, and oil stocks did well. But as they made their highs around May, we noted that they became overbought enough to say, let's take the money off the table. We've had a winner here. And so they were then going sideways, back a bit, up a bit. And then some of the grains like soybeans and wheat and corn in the last week had a nice little jump, and they came up to do what we call an inverted springboard. It's just the opposite. When you get a dropping market, comes into a sharp decline, and then we call it the springboard buy. Well, this is the opposite. It's the springboard sell on those grains, and that showed up in the GYX as well, which is the GKX, which is the grain index. And then by the end of the day, some of them were down quite a bit. Some cotton and lumber was down more than 2%. Coffee was down more than 3%. And the indexes there were down like 1.5%. So that was a serious hit to commodity prices. Now, where this works into the lower grade bond market and the widening spreads is that businesses that have these issued junk bond markets, and they are always having to offer up a higher yield than other, say, AAAs. So they have to service that debt, and they service it out of their cash flows, and their degree of cash flow depends upon their pricing power. And if you've got weakening commodities, you'll then have weakening wholesale prices, and then you'll have weakening or pricing pressures at the retail level. It gets very competitive. So then borrowers have trouble servicing junk bond debt. So, I hate to say it, but this week has made an important step towards a serious contraction. And this will be quite noticeable because the party since 2009 has been remarkable. The stock market has been very strong for an exceptionally long rally. The economy has been unusually long in expansion, but unusually weak in expansion. So the economy really isn't supporting what's going on in the stock market or what's been going on in the corporate bond market. So let's put out a big warning here on these sectors.
We'll have more with Bob Hoye right after this.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with market historian Bob Hoye. Bob, what's happening with crude oil?
Yep, it was part of the rotation whereby beat up commodities would rallied, and in May we advised taking money off the table in both if one was trading the product or if one was trading the stocks, and that's been about the right thing to do. When crude oil prices started to come down from last June, the establishment said, this is great because falling gasoline prices will put more money into the pockets of the consumers and that sort of stuff. But we looked at it as a cyclical decline for crude oil prices. Essentially, we were looking for that crude would follow and do the new price paradigm that natural gas did, in the beginning 5 years earlier, where natural gas markets became saturated. The fracking was working there faster than for crude oil, and so there were two things that got us bearish on crude. One was that thing that would fall in line with natural gas prices, and the other was that we're basically in a post-bubble contraction, whereby commodities would only have trading opportunities from time to time, but basically within a long decline. And this gets us to the U.S. dollar, where the senior currency in a post-bubble contraction becomes chronically firm against most other commodities and most other currencies for most of the time. So here we are now. The U.S. dollar has corrected a little here. It became extremely overbought in January, and we're now, I think it's preparing for another rally in here, which won't help things really. Then this, of course, gets us out to gold and silver, and our view on gold is that it really, to buy it in order to make some money, you're just playing a currency trade, and lately the currency trade has not been too good for gold and silver metal prices. The other way we could look at it is through an investor's eye, where one would want to trade the stocks. Now that's looking for better earnings at some time, but anyways, back in November, we did the major study and said that we're looking for a possible bottom in the precious metal sector, and that for that we would need to have the gold stocks beginning to outperform the metal price, which it did, and you'd also need to have silver beginning to outperform gold, which started as well. So the advice was to accumulate some gold stocks on weakness. And then the first rally came out right up to late January, early February, and it was a very strong rally, but it came right up to the 200-day moving average, and we were a little concerned about that, but didn't write anything about it. And then the next decline was lower than the intermediate correction, and then when you got the rally, it did get up to the 200-day moving average and was running out of momentum. So the advice then was in the gold stocks and sector to take money off the table. And then the last rally out into May was not as robust, and it was the same advice to take some money off the table. So one might say we're flat on gold stocks. I just don't see how one's going to make some money, but at the moment they're not overbought enough to consider shorting, and they're not oversold enough to consider buying. So we're just neutral flat on the gold sector. And as usual, one should own a little gold for insurance. You keep that in your safety deposit box. But as to trying to make gold, you're just playing money out of gold itself. You're just trading currencies. And it's not right time yet to begin to accumulate gold stocks for an intermediate rally. We would just stand aside. It's boring as hell, but we would stand aside. Hey, maybe there'd be some things to do during the summer.
Well, I've been told that this summer is not one where you should ignore your portfolio because things could happen very quickly.
Oh, yeah. Now, we're cautious. Fixed income, the advice on that high in January is to shorten term. And then now as credit spreads narrowed into May, it was to get out a spread product. Equities, general equities, it's going to take one more downtick, which may be on now, to then turn us quite negative on the general equity market. We're just waiting for a little more deterioration. So it looks like we've got a very boring portfolio.
Well, at least it means you're not losing money.
Oh, yeah, that's the point, is you want to keep it.
Bob, thanks a lot for chatting with us.
Good to be with you then, Jim.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Check out our popular YouTube channel, Talk Digital Network. You can forward comments about the show or questions for Bob to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.